So today we're going to take a look at Unit 7, Section 6, 7.6 on risk and investment funds. So go ahead and make sure that you have your notes out and a writing utensil so that you're ready to rock and roll with today's lesson. As you're getting that out and getting set here, and yes, I recognize we are skipping ahead a few sections. That's okay. We're going to come back to those other two lessons next week, so it's okay. But here's a little quote, Peter Lynch. An important key to investing is to remember that stocks are not lottery tickets. So again, we are looking at investing, we're looking at stocks. These are a long-term game plan. We're not looking at using this to gamble our money away. Okay. All right, so we're going to go ahead and start. There are three videos in this section that are really important for us to kind of take a look at and explain the different aspects. So make sure that while the videos are playing, you are respectful to those around you so that they can listen. There are a few questions to kind of answer and take a look at while the videos are playing, but make sure that you're respectful in allowing everybody to listen. So the first one we're looking at is regarding investment risk and learning to manage our risk as it's playing. Kind of think about how time, diversification, and investing over time play into kind of this investment risk and being able to use it to manage that risk.
Risk is one of the most frequently misunderstood terms among new investors. Let us show you what it really means and how you can use it to your advantage. We know that when we say risk, you think danger. Crossing the road without looking or getting in a cage with lions are the actions of reckless people after all. But unlike these risks, investment risk comes with a potential reward. If someone offers you £1 to climb onto the bottom rung of a ladder, you'd probably agree. You might climb to the second rung for £2. But at some point, the risk of falling off outweighs the reward, and it's where you feel comfortable in this balance between risk and reward that is your attitude to risk. So how does this apply to you and your investment journey? You can invest in any number of things, but when we talk about investing, we generally mean buying a small part of a company, a share. If the company performs well, then you'll make money. But if the company doesn't do so well, you could have less than you started with when you come to sell it. This is investment risk. Different types of companies will have different levels of risk and reward. Generally, the more risk you are prepared to take on, the better the potential returns. But just like with the ladder, you're in control. There are three ways you can adjust how much risk you take. The first is time. Now, this is the big one. The longer you leave your money invested, the better chance you have of making money when you sell the investment. But all investments, even the very best ones, go up and down in value over time. It's why we say it's important to invest for at least 5 years, as the odds get better the longer you're in the market, although there is always a risk of getting back less than you invest. The likelihood of you making money if you invest for just a day is around 50-50. But when investing for 10 years, the probability increases to more than 98%. This is what's happened historically, but things obviously change, so it might not happen in the future. However powerful time is, it's much less likely to work if you have all your eggs in one basket. So that leads us to diversification. By this, we mean you shouldn't invest in just one company. You need to have a mix. Different types of companies have different levels of risk and reward. For example, a small company just starting out will have a tougher time than a large, well-established business, but is more likely to experience significant growth. A company selling products for which there is a steady demand might have smoother returns than one where demand depends on the health of the economy. And equally, some countries are steady and established, while others are faster developing. If you invest in a good mix of companies, you're less affected by individual successes or failures. A lot of people choose to do this by pooling their money with other investors in a fund, where the investment choices are made by an expert. By doing this, it's extremely unlikely you would ever risk losing all of your money, as the individual companies the fund manager bought would all need to fail for this to happen. The third thing you can do is to spread your investments over time. If you don't have a large amount to invest all at once, this could also work to reduce your risk. The company shares you're about to buy could be more expensive or cheaper tomorrow. You'll never know. Buying your shares in a series of smaller amounts over a period of time means sometimes they'll be more expensive and sometimes they'll be cheaper, so you get an average cost over the period you're buying. This helps protect you from investing all of your money on a really expensive day. You'll never have zero risk of losing some money, but investing in a good mix of companies over a period of time and then holding them for the long term dramatically reduces the risk of investing your money. So you see, risk doesn't have to equal danger. When properly understood, it can equal opportunity.
All right. So hopefully you have an idea of how time diversification and invest over time help to manage your risk. Essentially, with time, the longer you leave it in for, the greater potential you have of earning money. With diversification, you have that mix of companies that allow for a various risk. Also consider different countries in this aspect also.
Risk
Um,
is
Different countries consider that in this, and also funds. Funds are another way that we can kind of adjust from there. Okay. All right. Vocabulary. So first off, um, risk is the degree of uncertainty. So the degree of uncertainty that an investor is to make money on an investment. So how likely an investor is to make money on an investment. And the key is that risk is that degree of uncertainty. Okay. Diversification. So we've talked about this multiple times. It came up in the video. We're going to look at another one in a moment here. But diversification is the idea of, or the practice of investing in a large variety of stocks, bonds, and or funds as a way to reduce your overall risk. And so bonds are typically pretty safe. Funds are that ability to kind of spread out across multiple things. In order to lose with a fund, everything in the fund would have to lose. The stocks, you can have various risk levels within the stocks too. So again, that diversification, that idea of not putting all your eggs into one basket, but having multiple different types of baskets around, and kind of spreading out the risk that you have. So that diversification really does, if a company is down, you hopefully have a diversified investment that another company is up at that same time. So you're kind of minimizing the loss that you have there. Okay. Asset allocation. So I have a video that's going to do diversification. We'll do that next after the vocabulary. So asset allocation is dividing an investment portfolio among different asset categories such as stocks, bonds, and cash. So asset allocation is dividing your investment portfolio among different asset categories. Okay. With that, you again just kind of looking at how can we diversify, and it's just what percentage or what dollar amount is going towards each of those sections there. Asset class is the group of financial instruments which have similar financial characteristics and behave similarly in the marketplace, such as stocks, bonds, and cash. So, again, asset class, the group of financial instruments which have similar financial characteristics. And then finally, last vocab there is dollar cost averaging. So, with dollar cost averaging, this is the practice of putting a fixed amount into an investment over a period of time, regardless of the price of that investment. And this kind of goes back to that very beginning investment risk video and the idea of invest over time. And so it's taking and spreading your money kind of out with investing. The dollar cost averaging is this idea that, okay, I have $50. I'm going to invest every single month $50. And so the first month that might only be able to buy me one share, but the second month the shares go down, which isn't a good thing. But say they're now $25. Well, now I can actually buy two shares with my $50. Okay, so then we go into the third month, and now maybe those have increased and they're, truly $75 a share. Well, now I can buy 1.5 shares. And so the dollar cost averaging over time and continuing to do that, you have an average for your investment per share. So this is one way that is a way for people who don't have as much funds or are a little bit more limited to kind of get into the market and to invest regularly by using dollar cost averaging. All right, so this video is going to talk about the power of diversification. So again, very important to diversify and to make sure that you are kind of minimizing any risk that you may have.
Diversification might be one of the most used and misunderstood words in investing. In this video, we'll discuss what diversification is and how you can use it to build your portfolio. Diversification is the attempt to reduce risk by spreading your investments across a variety of different asset classes, like stocks, bonds, and cash. The idea is that with the right diversification, some of the investments in your portfolio will be going up while others are going down, giving you overall market returns and a smoother ride over the long term. In general, there are two main ways to diversify: diversifying by asset class and diversifying across investments. Most investors start by deciding how to allocate their assets among stocks, bonds, and cash. How you do this depends on your investment objective and time horizon. Generally speaking, the younger you are, the more equity such as stocks you should hold. As you approach retirement, you'll gradually shift toward more conservative investments like bonds and cash. One thing to note is that with interest rates at all-time lows, investors have been looking to alternative investments for higher returns and further diversification. Remember that the search for higher returns may mean greater risks and costs. Once you've decided on the big picture asset allocation, it's time to choose investments. You can further diversify the stock portion of your portfolio by purchasing individual stocks in a variety of market sectors, or by investing in a diversified basket of stocks through a mutual fund or exchange-traded fund. The same goes for bonds. E-Trade offers a full range of investment products across asset classes. If you work for a publicly traded company and hold a significant portion of your wealth in company stock, diversification is especially important for you. You may experience significant losses if your company fails to perform. Diversification may help you mitigate that risk while maintaining the potential for long-term growth. While diversification is important, you should not assume that it completely eliminates risk. It is simply the attempt to reduce risk by holding a basket of securities that behave differently in different market conditions. Also, diversification does not guarantee that if one investment goes down, another investment will go up. Risk is real, and diversification has its limits. Despite these limits, diversification is an effective strategy for long-term investors.
All right, so kind of that question that is on there, very bottom of your notes there. Diversification doesn't guarantee that if one investment goes down, another will go up to make up for it. Why is it still a good idea to diversify your investments? Essentially, you still want to not have all your eggs in one basket. You want to reduce your risk as much as possible, and essentially over the long term, and the long run there, diversification is effective for managing your portfolio and reducing your risk. So again, for the long term, it definitely is something that you want want to make sure you're kind of counteracting, because again, you can't know what is happening in the market until after it's happened. And so the diversification kind of allows you to kind of minimize any risk potential that you have there. Here's kind of just an example of a diversification. Can be simple or it can be complex. So over here we have a very basic diversification of a bunch in an S&P 500 index fund and some in a bond fund. Okay, we've got another one, a little intermediate. We've added in an additional bond fund, a mid cap fund, a small cap fund, and then this developing markets fund. So again, it can be simple, it can be complex, and really when you start investing, it can be done for you. You can just say what kind of diversification you're looking for, and it can kind of just automatically create this pie for you. And then, like I said, a more advanced approach. We've got different small, medium, large cap. We've got a real estate in here. We've got different bond funds that are also playing into this diversification pie graph here. All right, go ahead, turn the page. We're have a few more vocabulary regarding funds. So we've talked about the diversification and our risk factors. Now we need to start looking at different types of funds and really understanding why funds are a good place to start. Okay, so an index fund is a low fee portfolio of stocks chosen to track or mimic a stock market index, thereby removing the human element of investing because no one is choosing the individual stocks. So the index fund is chosen to mimic a stock market index. So your stock market index being the S&P 500, the NASDAQ, or the Dow Jones. Okay, again, in United States markets. And so these are good because it's already put together for you. You just are choosing what amount you want to invest in that. And it just kind of just does its thing. And you don't have to worry about, well, should I invest in this company or this company? Or, oh, they had a really good track record last month, but this week they're not looking so good. So it just allows you to kind of jump into the market a little easier than, again, risking or putting your money all in one company. All right. On the other side of that, we have a mutual fund. And so a mutual fund is the collection of stocks and or bonds combined into one fund, which will be traded as a unit, typically chosen and actively managed by an expert, in exchange for a fee from each investor. So an index fund is taking the human out of the mix. But a mutual fund is created and managed by a person. And so this is a person that is deemed to be an expert, your financial advisor, your financial manager, an expert. And then they are basically making money from a fee that they are charging you. Okay. So again, if you don't want computerized running it for you, you can look at the mutual fund aspects. These are still going to kind of track or mimic a stock market index usually, but they are also going to be built to have a little bit higher return. But remember, no return is actually guaranteed. Okay, target date fund. So last vocabulary there, the target date fund. These are newer and actually probably a really, really good place to start when you're looking at building your wealth. A target date fund or a TDF is a type of investment fund that rebalances its asset mix over time based on a projected retirement year. So based on your projected retirement year, it reallocates the amount of money or the mix, like what percentage of your portfolio is going to various aspects. So let me jump over here to this. We go 16. Here we go. I won't play this video, but the target date fund. So basically what it is, it's This idea of set it and forget it. Okay. You basically choose you select the fund based off of your kind of retirement date. So the nearest one to when you think you would retire. Okay, I want to retire at 50. And so when I'm 50, it is going to be this year, whatever year that is. And you find the fund that matches that. And during that time, based off of your risk tolerance that you select, so whether you have a low, medium, or high risk tolerance to begin with, but however long your time horizon is. So if I have 30 years till retirement. Well, let's go with you guys have a little bit longer. So you've got 40 years to retirement. You invest in this target date fund. You have 40 years. Early on, it's going to be much riskier. But as you get closer to retirement, as you're 10 years out, 5 years out, the asset mix that it has actually goes to a more conservative approach so that you are not risking a lot. So if it loses, it's not going to lose big on those. It does it automatically. And so that's why target date funds have really become a little bit more popular. It does it automatically and reallocates automatically on its own. So it helps you stay on track for your retirement. So that's kind of what that target date fund is. All right. So, what is a fund? A fund is a good strategy to invest in a variety of stocks so that you can minimize risk. While you can individually pick stocks and manage them yourself, most people buy shares of funds that have a collection of stocks. It's a lot of work to manage individual stocks. You're also not able to maybe invest as much or as often because one share of a stock could be, $300. And so you're waiting to save up versus in a fund, I can just invest $100 here, $100 there, $300. I can invest different amounts at different times. And so it makes it a little bit more manageable for it beginning to invest and continuing with that. Investment funds take the contributions of fund investors and purchase a portfolio that may include stocks, bonds, short term debt, or a combination of assets. So, again, it is diversifying your portfolio. That's what a fund is doing. Investors don't actually own the underlying assets, but rather buy shares of the fund. So, they are also known as shareholders as the total value of the stocks or bonds within a fund rises and falls, so does the value of the fund shares. So within a fund, you could have we'll just say within this fund, maybe it's Amazon, maybe it's Nike, it's Chipotle, it's Southwest Airlines, and you've got this collection of things within this fund. And so if the stock of Nike goes up, then your value of your fund shares have also gone up at the same time. But if Nike goes up and Southwest goes down, again, now maybe they have kind of net nude each other where they are they balance each other out. You aren't losing, you aren't recognizing that there is any issues with that. Types of funds that we have. All right, so we have several different types of funds. We're not going to go into details with these. We've kind of have talked about the main ones. You have mutual funds, you have money market funds, index funds. So remember, index funds are automatic, okay, chosen to mimic the stock and has removed the human element. Mutual funds are going to be managed by a person. We have what are called ETFs, exchange traded funds. We also have real estate investment trusts. So again, we're not going to talk about these, but I'll give you kind of another slide that will give you a gist of all of them. And then we also have hedge funds. So these are the 6 different types of funds that there are. Okay, I'm going to kind of just put this one up there so that you can look and read it, but you can access them later if you didn't get the list. They're still kind of up here. These are just kind of a little bit more details about those types of funds that there are. Okay, so I'll give you a minute to kind of skim through that. All right. Here's just a graphic of some index funds. Index funds copy the performance, um, and are meant to, as the market goes up, the index fund is supposed to track with it. I do like that it has kind of benefits down here. Its diversification is good, low cost. So again, whenever you're looking at investing, there's always fees associated, and so you always want to find the least cost that you have to pay for it. And so index funds, because they are not professionally managed, are going to be your best in terms of the lowest cost. And then they have a pretty good solid track record. All right, go ahead, turn. Okay, we're going to talk about,
Success.
oops, here we go. We're going to talk about active and passive investing. So, active and passive investing here. And then we'll go into a few details with the active and passive investing.
Investing in the stock market is a great way to save up for those big things in life. Your kids' education, the house of your dreams, and of course, your retirement. There are two main ways for you to invest: active investing and passive investing. With passive investing, your money is used to buy shares in a group of companies. This group of companies is called an index. If these companies collectively do well, so will the index, and your money will grow. Because passive investing requires little human intervention, fees are fairly low. However, as passive investing only matches the performance of an index, your investment does not outperform that index. Active investing, on the other hand, means you have a dedicated portfolio manager handling your investment. Active managers want to outperform the index. They use your money to buy shares in companies they predict will do well and avoid companies they think will fail. Your manager will try to seek out good investment opportunities to really make your money grow. The bad news is this doesn't always happen. With active investment, there's room for error, so a lot depends on finding a great manager who can pick investments better than the rest. Because active managers are so hands-on, they also tend to charge more for their services. So what's best for you? If you find the idea of choosing an active manager daunting, passive investing may be the way to go. But if you prefer to risk more to potentially gain more, an active manager may be more your style. A good idea might be to combine both active and passive funds. Striking a balance between the two means you may just get the best of both worlds by starting to.
All right. So, when we're looking at
Invest.
active and passive investing again. So kind of a lot of things to think about there. On this chart here on the next page, who manages the fund when it comes to passive and active investing? On passive investing, no one does. It's based on the performance of an index. Okay, so passive investing, no one is managing. Again, it's computerized essentially. On an active investing, it is a human fund manager. Because the passive is not managed by anybody, your fees are going to be, oops, that is not where it should be. Your fees are going to be lower for passive investing. And for active investing, the fees are actually going to be higher. Okay, so active investing and passive investing, your fees. So here we go. Lower fees here for passive, and active is going to have higher fees because, again, it is by a human. Okay. Returns. So, understanding that on passive investing, they are only looking to match the return of the market. Okay. If it exceeds it, then that's great, but it's really just designed to match the return. But active investing is looking to outperform the market. So again, you have to kind of weigh the cost with is that what you want to do? Is that higher fee worth the aspect of outperforming the market and gaining a higher return? All right. And then lower or higher risk. Passive investing is a lower risk. So I hadn't intended to write this here. Passive investing is lower risk and active investing is higher risk. Anytime you're looking to outperform the market, it's always going to be a higher risk. All right. So make sure that you kind of fill that in your notes also. Just a few other things when it comes to passive and actively managed funds. Again, the index funds mimic one of the already established indices. So when we're looking at that passive index, that passive investing, it is to mimic one of the indexes that we have. So the S&P 500, the NASDAQ, or the Dow Jones. And again, just matching those returns. Because the actively managed funds are managed and chosen by investing professionals, they have to be compensated for that work and that time and that knowledge. And so, again, that's why you're going to pay a higher fee for that part of it. All right. And then the last part that you have there, just your little kind of check for understanding. Oopsie. Let's clear the writing. Here we go. Clear my drawings. There we go. Okay, there we go. So exit ticket there. You've got 3 questions. So make sure that you are able to answer those 3 questions. They're going to come up frequently. And then again, you have your test coming up pretty soon for this unit. So first question when talking about investing, what does it mean when someone refers to a fund? Okay, what does it mean when someone refers to a fund? So go ahead and select your choice there. Question 2 there, the goal of an actively managed fund is to outperform the market. What does this mean? And then the last question that you have, question 3, all of the following are true about a passively managed fund, except go ahead and make your selection there. Okay. Essentially, when someone refers to a fund, they are talking about a pool of money from shareholders that is used to invest in a collection of assets like stocks and bonds. The goal of an actively managed fund is that the fund is managed by a fund manager who tries to beat the overall market's rate of return. And then a passively managed fund, all of these are true with the exception of D, passively managed funds are managed by a fund manager.